Every time a country collapses, a few banks quietly celebrate. When nations drown in debt, citizens lose homes, savings vanish, and entire currencies crumble. Yet somehow, the same financial giants report record profits. How can that be? How can the same crisis that destroys millions of lives enrich the institutions that caused it? What if national bankruptcy isn't a failure of the system, but a feature of it? Stay till the end, because what you learn about how nations go broke will change the way you see every economic headline, every debt deal, and every financial rescue plan you've ever heard of. Let us start with a simple truth. Countries don't really go bankrupt like people or companies do. When a person goes bankrupt, they've run out of money. When a company goes bankrupt, it's because their debts exceed their value. But when a nation goes bankrupt, it's something far stranger. Governments don't run out of money. They can always print more. So how do they fail? They fail when trust collapses. And that collapse more often than not is engineered by the very financial systems meant to protect them. To understand how, we have to travel back to the 17th century, when modern banking was born. In 1694, England was broke. War with France had drained the treasury, and the crown needed money fast. Enter a group of wealthy merchants and bankers. They offered the government a deal. We'll lend you the money if you let us create a bank that can issue notes backed by that debt. That deal created the Bank of England, the prototype for every central bank in the world today. It was a simple but brilliant arrangement. The government borrows money. The bank creates money out of that debt. The people pay the price through inflation and taxes. From that moment on, debt became the foundation of money itself. Every war, every empire, every modern economy would now depend on one thing: the ability to borrow. Fast forward to the 20th century. After 2 world wars, most nations were buried in debt. But something strange happened. Rather than collapsing, the world built an entire financial system on top of that debt, the Bretton Woods system. In 1944, global leaders met to rebuild the economy. The US dollar was crowned the world's reserve currency, backed by gold. For a while, but by 1971, the gold backing was gone. President Nixon cut the tie. Money no longer represented anything real, it became pure trust. From that day on, nations could print as much as they wanted, as long as someone was willing to buy their debt. Who buys it? Banks, investment funds. And ironically, other governments' debt was no longer a burden, it was a product, and the sellers of that product were the world's biggest financial institutions. When a developing nation borrows from the International Monetary Fund or the World Bank, it's not just money, they owe its control. Take Latin America in the 1980s. Countries like Mexico, Brazil, and Argentina were encouraged to borrow heavily. The loans were given in US dollars. But when interest rates skyrocketed, those debts became impossible to repay. Result: the Latin American debt crisis. Economies collapsed, currencies were devalued, millions fell into poverty, and yet the same banks that issued those loans were bailed out paid in full by restructuring deals and government guarantees. Sound familiar? Because it happened again in 2008. The global financial crisis was sold to the public as a housing collapse. But at its core it was another sovereign debt crisis. Governments stepped in to save the system, borrowing trillions from central banks. And who benefited? The same institutions that caused the problem. Nations went deeper into debt. Banks went back to paying bonuses. When nations go bankrupt, their citizens don't get rescued, they get punished. In Greece, after the 2010 European debt crisis, hospitals shut down, pensions were cut, and unemployment soared. But international banks were repaid every last cent thanks to bailout packages disguised as rescue funds. The irony: those bailout funds came from new loans. Greece was forced to borrow more just to pay the old debt. A cycle of financial servitude. Meanwhile, global investment banks like Goldman Sachs, which helped hide Greek debt in the first place, made millions in fees. This isn't an accident, it's a model. Every time a country collapses, the debt doesn't vanish, it's transferred from the nation to the banks, from the people to the financial elite. Underscore, you might think, well, maybe we just need better regulations. But history says otherwise. After every crisis, new rules are written, old ones are ignored, and the cycle repeats. Why? Because the system's engine is debt itself. If governments stopped borrowing, the financial system would collapse. Central banks claim they're managing inflation, but they're actually keeping nations addicted to low-interest loans. That's how growth is measured, by how much more debt can be created. And every time a crisis hits, they print more money to save the economy, which devalues the currency, raises the cost of living, and traps future generations in even deeper debt. Underscore, look at today. Global debt has passed $315 trillion, more than triple the world's total GDP. The US alone owes over $35 trillion. Japan's debt is over 250% of its GDP. And yet, stock markets are booming, and banks are reporting record profits. How? Because banks don't care if the debt can be paid back. They profit from the interest, the fees, and the chaos. When nations default, assets are sold off. When currencies crash, investors buy them cheap. And when people panic, money floods back to the same safe havens, big banks, and central institutions. It's a cycle of fear and profit played over centuries. Understood? Nations don't fail by accident. They fail by design. The same entities that fund governments also profit when they collapse. Debt isn't a mistake. It's the product being sold. Two crises are profitable events. Every collapse transfers wealth upward through bailouts, privatization, and currency devaluation. The losses are socialized, the gains are privatized. 3. The illusion of recovery hides permanent dependency. When a nation recovers, it doesn't regain independence, it signs deeper into the system that owns its debt. Under underscore. So the next time you hear a politician say, "We can't afford that," or "We need to borrow more to save the economy," remember, you're not hearing the language of rescue. You're hearing the language of control. Because as long as money is created from debt, every crisis will make the rich richer. And every solution will keep nations enslaved to the same masters. The truth isn't that countries go bankrupt. It's that they're allowed to when it's profitable for the right people. If you want to break that cycle, start by understanding it. Question every bailout. Follow the money. And most importantly, share what you learn. Because awareness is the first form of real wealth left. At last, I just want to say something. I'm your host, and this was how nations go bankrupt while banks get richer. If you found value in this, hit like, subscribe, and let's keep exposing the systems that profit from our collective debt.